Today's financial markets can be summed up in 3 words: global, fast, and complex. But as the market structure evolves, so must the regulatory structure that oversees it. John Lothian News has spoken with several industry experts and put together this series on the evolution of financial market structure. In Part 3, Keith Ross, CEO of PDQ ATS, offers his thoughts on HFT, regulation NMS, maker-taker arrangements, and dark pools, and voices his concerns that regulatory oversight may give way to legislative overreach.
I've always thought that a healthy, functioning capital market wants to be able to include all flavors of participants, whether it be the little one-lot guys that used to be important in the pits on the floor, whether it be high-speed traders, agency brokers, retail. They're all part of the ecosystem. The thing that people might underestimate is the high-frequency crowd will adapt to whatever rules are put in place, and they will still do well. If you start to monkey with what's going on, particularly a speed bump, I mean, to me, that's fairly obvious, because you now have to say, what is my 500 millisecond bid, rather than what is my current bid that I know I can cancel in a couple milliseconds. A 500 millisecond speed bump would be like putting rumble strips on Route 80 and slowing down all the trucks going across the country. Yes, there'd be fewer traffic deaths, maybe there'd be fewer speeding tickets, but the cost of all the goods delivered is going to go up because it's going to take longer and be much more expensive. I've written about maker-taker before, and my argument is it's just a function of the pricing mechanism. So a liquidity provider needs to make a little money to keep providing liquidity. They can either do that through spread capture, or in the case of stocks, they are so highly efficient, it turns out their margins are a fraction of the rebate. If you've ever been to Europe and dined out at a restaurant, when they hand you the bill at the end of the meal, the service is included. But in the States, you get to add the tip. You get to add the service fee. That's the same as the taker fee in the market. If you make it go away, you're still going to pay the price, but you may not see it as a service fee. What the last 15 years have done is to break down the specialist monopoly of the New York Stock Exchange. And even when I was at GetGo in the early 2000s, if we sent an order electronically to the New York Stock Exchange, the specialist had 30 seconds to respond and acknowledge the order. And then if you wanted to cancel, he had an additional 30 seconds to decide if you were out or not. And even in a electronic trading era that was measured in seconds instead of milliseconds, that was a long time. So the whole idea behind Reg NMS was to get people to display more, because you were now going to get a rebate if you displayed. And in 2005, for a short period of time, there was probably some more display, but the dark trading then was only 16 to 20%, and now it's closer to 40%. So something has happened in our market structure such that people want to trade in the dark. If we go into an emotional frenzy and Congress decides that they understand what's going on and try to legislate changes, then I think we should really be concerned. They should just empower the regulators, the SEC and FINRA, who know what's going on, to make suggestions and make changes. I think the measured approach that people have been upset with, I'll say, over the last few years has actually been good, because if you look at the markets overall, they are amazingly efficient, amazingly liquid. And at this other conference I was talking about, there was a manager who said, well, I move my portfolio around in the United States between stocks and bonds and other asset classes, but I can't do it in other countries because the markets aren't liquid enough. So he felt much more comfortable having significant, billions of dollars of assets in the US because the markets function well.